U.S. consumer confidence coming in at a one-year high. That's one of the reasons we're up today. The other reason we're up today, Europe, yeah, you guessed it, they upped. Imagine that. They upped the amount of money they are going to put towards Greece and various other countries that need it. So bottom line, the rally started early and has just kept going. You're looking at the Dow Industrials up about 65 points right now. If you look at the NASDAQ, that's kind of curious. NASDAQ has been lagging today. And, of course, Apple has been struggling today. We know when Apple struggles, a lot of the NASDAQ tends to struggle. And one more chart I want to show you guys. Take a look. This is pretty dramatic. This is the 10-year. Whoa, what happened there? About an hour ago, the yield on the 10-year shot up. Think about it this way. This is quarter end, all right? And at quarter end, you talk about marking up stocks if you're long. Well, this has been the worst quarter for bonds in about 2.5 years. So if you're long bonds, you don't necessarily want to show that to your investors. So what do? You sell bonds. And as you sell bonds, obviously the yield goes up. Maybe it's the quarter marked down, people getting out. That has something to do with that bond chart. Pretty dramatic, though, isn't it? Yeah, indeed. Indeed it is. You know, we've got a terrific sort of quarter-end show. Yep. Gearing you up for what you need to be doing next quarter. Monday morning, our special guest host for the close and beyond, Michael Gayed, Chief Investment Strategist at Pension Partners. He called last summer's crash a month before it happened, everyone, and the ensuing fall rally. So he's got a terrific track record. You're predicting very bold things to come as well. Give us a little snapshot of that.
And I'm predicting that exactly because we're starting to see yields rise, just like Adam mentioned. The reality is, I think we're at a moment here, which I'm calling the spring switch, where finally the retail investor is going to begin to believe in this rally. Finally, scared money will get scared that it's going to miss out on further gains. Money will come out of bonds into stocks. The great reallocation, I believe, is at hand. Okay, what's that going to mean for the markets, the equity market? Well, I think in general, the potential here for further gains is pretty substantial. I've been arguing that we could see a 40%-like move in 2012.
40%. Not from here, you're saying?
Right, from here, roughly 40% total, roughly 30% more. Now, now, what's making me say that is in reflationary periods, coming off of a deflation scare, which was really what 2011 was about, you tend to have very big moves in risk assets. I referenced 2003. Off of the low, the S&P, coming off of the deflation pulse, rallied 40-something%. In 2009, off of the low, S&P rallied 67%. My point is that the commonality there is this swing of the pendulum away from deflation back into inflation, which is actually a good environment for equities. Well,
you've actually quantified that on a chart for us. Maybe we can bring that up. I believe it's the TLT, which is the yield on the 10-year versus the S&P 500. It's a ratio. Why don't you explain what this means?
So think of
price of the 10-year.
Right. So this is a bond stock price ratio. Now, a rising ratio means that bonds are outperforming up more or down less the S&P equities. Now, you can see in 2009 that ratio trended down as investors got more comfortable with risk taking. That ratio bottomed right around mid-April before the May 6th flash crash of 2010. So what I'm suggesting is that there is some predictive power in the trend of the ratio. You saw bonds outperform, significantly do better than stocks following that. Then in September, that ratio peaked out. Bonds started underperforming equities as the QE2 infused rally began. But a lot of people say, you know, because one of the sort of fundamental reasons, you're looking at this, of course, from a technical perspective, but one of your fundamental reasons is that there is a lot of money on the sidelines there. The retail investor hasn't bought in as of yet to this rally. They're starting to get, or at least we anticipate in the coming quarter, that they're going to buy in and start buying up equities. Most people would tell you, when you see the retail investor get in, it's time for smart money to get, the heck out of there. Money is right on average, but it's wrong at the extremes. And in other words, what we could have here is, the reason volume has been slow is because nobody believes in this rally. The further that we get closer to the all-time highs, which is roughly 8 to 10% on the Dow Industrials, that can happen next month for all I know. I can promise you, you're going to have a lot more excitement by individuals. So a lot more volume. A lot more, so volume will begin to increase. People will begin to believe the rally. And coinciding with that, people will start to say, well, wait a minute. I'm earning roughly 2.2% on a 10-year. The inflation target of the Fed is 2%. So basically, the Fed is saying, if I buy bonds, I'm going to make 0.2% every year for 10 years. It doesn't make sense. We're in an environment where the risk may be to not take the risk. To simply keep up with inflation, you're going to have to go into stocks. All right. Well, we'll see if it all happens. Michael Gayed, we're going to be talking a whole lot more with you.